This is Optimal Finance Daily. 6 Principles the Best Investors Use to Crush the Market by Phil Town of rule1investing.com. And I'm your host and personal finance enthusiast, Diana Merriam. This is the show where I read to you from the best personal finance blogs on the web, with the author's permission, of course. And now let's get right to it and start optimizing your life. 6 Principles the Best Investors Use to Crush the Market by Phil Town of rule1investing.com. The following 6 principles come from the Rule Number 1 tradition. In 2014, the nonprofit group, the American Association of Individual Investors, rated the Rule Number 1 hedge fund strategy the number 1 hedge fund strategy last year. Our hedge fund produced 50% returns last year. The best investors in the world use these 6 principles. They are awesome. They have been around since the 1930s and they are still practiced today by the best investors in the world. Investors like Warren Buffett, Charlie Munger, David Einhorn, Manish Pabri, and myself all use these 6 principles and we get great returns. Rule number 1 states don't lose money, and these 6 principles are always on my mind to help me avoid violating that critical rule. Number 1, radar. This is easier said than done when you're investing real money. Money you can't afford to lose tends to be hot or emotional. Pro gamblers try avoid sitting down with more than they can lose, but anyone investing all of their own hard-earned money is always sitting down with more than they can lose. Fear of losing more than you can afford to lose tends to make the mind go irrational. You start guessing. You can't tell the difference between a good idea and a bad idea. Investing decisions are not life and death decisions, but still, remaining rational in the face of intense emotions is an art that's learned in the trenches. Number 2, understand the business. Understand what you're buying. Stick with what you know and realize what you don't know. Focus your attention on industries that you're already comfortable with. Imagine that you are going to have to own and operate a business. Can you do that in an industry where you're seriously thinking of making an investment? You need to be able to understand the business if you want to buy it. Number 3, love what you own. Put your money where your values are. Many of us have the intention to make the world a better place, but seem to forget that in the businesses that we invest in and have a direct impact on what's going to exist in the world in 20 years. 85% of all the money in the stock market is little guy money. This is money from our 401ks, our retirement plans, and our pension plans. Vote for the future that you want to see by investing your own money into businesses that you want to see 20 years from now. Investing in companies that you love transforms it from a chore or obligation into something that you're passionate about, something that's fun. Number 4, wait for an event. When you boil it down, we buy fear and we sell greed. Fear creates a lot of selling action. When stock prices are set by the most fearful or the most greedy investors, those who are fully in the sway of emotion, it's clear that the market prices are often far from rational. The big players in the market, mutual fund managers, pension fund managers, insurance fund managers, and bank fund managers, are not the most cold-blooded rational creatures on the planet. When the market begins to go down, these greedy investors get out quickly to avoid losses. If the company is wonderful and you understand it, that's when you take advantage. Number 5, reduce your basis. Your basis is the amount of money that you have on the table. All reduced basis means is getting your money off of the table. This is the unsung hero of the Rule Number 1 saga. You can lower your basis with return of capital. That means cash flow strategies from dividends, buybacks, derivatives, really safe options trades. When you reduce basis, your risk of losing money goes down proportionately. You lower your risk of losing money by reducing your basis. When my basis goes to 0, where's my market risk? If I start spending the money to live on instead of reinvesting it, then the basis stays the same, but the return still goes up because you're getting dividends every year. In essence, I've created for my retirement a kind of special bond, one that's backed by one of the best companies in the world and yet pays out based on an ever-increasing coupon rate, one that within 10 years is over 20% a year and rising. Number 6, create a story. Create a story for the company you want to invest by combining all of the previous principles into a cohesive idea about why this is a great company. Then once you have that story, invert it by flipping it to the opposite point of view. You should try to create the argument that this investment is a dumb idea, and if you can't, then that's a sign that you don't know enough about the company yet. You just listened to the post titled 6 Principles the Best Investors Use to Crush the Market by Phil Town of rule1investing.com, and I'll be right back with my commentary. I think this article might have something to offer for people who are interested in actively managing their investments, or for people who are buying and selling individual stocks. I personally prefer passive investing with low-fee total market index funds. I don't need to worry about researching individual companies or thinking about how I would run the business because I'm investing in indexes that mimic the entire US stock market. I prefer this strategy because it enables me to manage my investments myself without spending a ton of time on active management. I'm also not paying any management fees for someone else to actively manage my portfolio for me. I'm a bit weary of an investor boasting 50% returns. Notice that he stated that this was in 1 year. Studies have shown that the majority of active investors don't beat the market over time. So while a 50% return is impressive in 1 year, I think it's much more important to look at performance over a longer period of time. As a long-term investor, I'm not trying to beat the market. I want to match the market. I do think there's some merit in the third point here. Love what you own. I'm seeing more and more friends move towards sustainable and socially responsible investing, which focuses on investing in companies that are engaged in social justice, environmental sustainability, and alternative energy or clean technology efforts. There are indexes available for this type of investing as well, and you may also hear them referred to as ESG funds, which stands for Environmental, Social, and Governance. And that's it for today. Thank you for listening. Have a great rest of your day, and I'll see you in tomorrow's show where your optimal life awaits.